All right, everyone, we are live. Welcome to everybody joining us. This is the shocking truth about the future of multifamily investing. My name is Bronson Hill, and I'm really excited to host this event. We've got three amazing people here who are going to talk about what is happening right now within the multifamily space. So I'll go ahead and give them a quick introduction. So we have Neal Bawa from Grow Capitus. We've got Jorge Abreu from Elevate Commercial Investment Group, and Tyler Chesser, the co-founder of CF Capital. Really excited to have each of you guys here. And just a little quick bit about the format tonight. What we're going to do is we're going to basically go through some preset questions, and we're going to do some Q&A. So those that are attending live, some people are watching this on a replay, but those that are live basically can type their questions in the chat box later on in the program. So we'll go ahead and get started. So welcome, gentlemen. We'll start out actually with Jorge first. So Jorge, why don't you talk to us just briefly, how has COVID affected multifamily investing, and what do you see the current opportunities being?
So, it's affected us in our we looked at our strategy and kind of made some adjustments. We've just closed on an A-class 2017 build. We have a 2020 under contract, and looks like we're going to get another 2017 build under contract. Before COVID, I was not looking at any A-class. I was doing some builds, so I do some new development, but I wasn't buying any existing A-class. And what kind of drove me down that path was some of the hardcore workforce housing did get affected from COVID. And that's what got me looking closer into also some B plus products or B class. We were heavy in your true workforce housing C class. We still are, but we're a little more specific in what areas we go after. Obviously the financing has stayed very aggressive, especially the beginning of this year till now, which has made a lot of opportunity in that sense when you take the type of financing you can get right now. And yeah, I don't know. I can expand in a lot of different directions.
Sure. No, that's great. No, that's a great little intro to kind of where we're headed. And again, for each of our speakers here, if you go back to the landing page where you registered, you can see more about each of their bios. You can check out and see just an incredible amount of experience on this panel here. So I think one of the biggest challenges these days, at least from what I've realized, is really finding deals. And so I think, Tyler, you have a really unique perspective on this from having been a commercial broker and really, launched in the last, number of years into syndication and just, seeing and finding some great deals. What do you see kind of working out there for finding deals these days?
Yeah, well, the timely or really the timeless principle is relationships. At the end of the day, it's all about relationships and obviously a reputation for getting things done and being easy to work with. And so that goes without saying. But, it really comes down to timely feedback as well, because the market moves very fast, especially right now. I mean, one of the things I think Jorge was really hinting at is that there's a ton of activity, right? There's a lot of deals. I mean, 2020, there was a very tight window of opportunities because I think people were trying to figure out what's happening in the marketplace. And so you had a lot of transactions that were bottlenecked and moved towards, Q3, Q4 of 2020. And that really was an avalanche of 2021. So there's a lot of opportunities, a lot of deals. And so timely feedback remains to be, very, very important. The other thing too, right now is that, what's worked for us well, like the past two deals that we've done have been direct to seller or pocket listings. And both of them have been deals that we've got to solve problems for, right? They don't fit every single perfect box. And I think that's critically important to recognize, is that if you want to be successful in today's environment, unless you want to overpay, unless you want to buy a deal and get super aggressive, perhaps, and obviously there are deals that make sense, that appear aggressive, but you've got to be a problem solver. And so that's what we try to do, is we try to solve problems. And, if we have somebody coming to us direct, whether, directly without a broker, obviously there's most likely going to be a problem that we've got to solve there. So that's really what's working from a high level. But I think, the timeless principles of relationships are key, which is one of the reasons why it's great that we're all spending time together, is that we're continuing to strengthen and develop those relationships, because who knows, the next time we, run into each other on a deal and we say, wait a minute, I remember spending time with you and I can trust you, so to me, that's the thing that will never change. But of course, in a very dynamic environment, it's about solving problems more than anything for us.
Yeah, I agree. Solving problems really is what you get paid to do in multifamily, in business, and I think it's just a great thing. We were actually kind of making a joke earlier that we have 3 follically challenged guys on this panel, and we were saying, if Neal really needed an intervention to add value, we could help. So, so we get a lot more views that way if we helped you that way. But speaking of shocking, that would be pretty shocking. But Neal, tell us a little bit about what you see kind of the shocking future of multifamily being, or where is multifamily headed?
Well, I'll take maybe a moment to set the groundwork for that, because this question is so key, right? And it's also part of the way that Bronson does his events, right? That word shocking is part of that. On Jan 1st, 2020, the price of Bitcoin was around $7,000. Earlier today, Bitcoin touched 49,000. Okay? 7,000 before COVID, today 49,000. The second piece of it, which is tied to the first one, is that 40% of all dollars ever printed were printed in the last 12 months. 40%. I mean, and we've been a country for 230 years? And 40% of all the currency we've printed in our entire history happened in the last 12 months. So these events are extraordinary. They're earth-shaking. They leave 2008 in the dust. They leave 2001 in the dust. So when you try to understand why the future of multifamily is shocking and the future of anything is shocking, you first have to wrap your head around these two things. Bitcoin, to me, represents investor fear and investor frenzy, because it's an asset class that basically started off as, we don't like the government, we don't like printing. So obviously it represents people's fear of relentless government money printing, but it also represents speculation at its finest level for a product that has no cash flow, right? It just is pure speculation. All the central bankers hate it. So all you're getting out of it is future appreciation. So it's the most speculative product ever. So with the background of that, those crazy numbers, here's what I think is a shocking future of multifamily. Inflation, which we've been talking about for the last 7 years, which just never reared its ugly head, is finally here. So when you create, and by the way, if you're thinking, well, the US created 40% of inflation, if you look at what the rest of the world has created in the last 12 months, those numbers are even more outrageous. So bottom line is that today I feel very, very strongly that the world is in for a significant bout of inflation in the next 24 months, the kind of inflation that we have not experienced at all since the 1970s. And multifamily is going to be affected both in a very positive way and a negative way. So the first effect is an obvious one that we've already seen. Cap rates have declined in all different asset classes in the last 3 months. When you're looking at cap, it's clear now that multifamily cap rates are below 5%, and Class A assets are falling to 3% and even under 3%. There's Class A assets being transacted today for under 3%, and I'm not talking downtown San Francisco or New York. So there's clearly a downward effect on cap rates, and a lot of people are like, this is temporary, it will go away. My question is, that 40% of money that we printed, none of it is going back in. There's actually no mechanism to take that 40% of money, that $10 trillion, and put it back in. It's out. It's a genie. It's out of the bottle. There's no real way to put it back in. So when there's $10 trillion more of money to buy the exact same assets that we had last year for the exact same population, it's going to create asset inflation. And we are seeing that in multifamily at an absolutely astonishing, crazy level. Assets that I purchased for $55K, I'm selling for $120K. These are 1970s assets, and there's tons of people buying them. Here's a better example of how the future of multifamily is shocking. I won't name the asset, but I have a nice asset that I like. So I'm selling this asset. Guess who's buying it? Me. I'm selling the asset, and I'm buying the asset. Because the world world has changed so much that the valuation that I had for this asset, which was, $10 million, $12 million less, and I've made, my investors are going to make 50% annualized on this asset, by the way. And I know that all of them will roll over 1031 money because they buy my argument, which is the world's changed around this asset, even though the asset remained the same. And to me, I think anybody that doesn't buy that argument cannot be in the multifamily market today, because there is not a single person in this country that can say, I am conservative and will underwrite the same way as I did the last year, that will actually buy any property at all. It is absolutely impossible to come even into best and final based on underwriting standards from 12 months ago or 15 months ago. So the biggest change is underwriting standards change. Your assumptions of cap rate are gone, and you must factor in very significant persistent inflation over the next 30 months. And I know that's a separate question that, Bronson, you wanted to ask, so I won't go into it. But these are really these three. We have a room with three massive 800-pound elephants in there, so it's getting really crowded.
Right. No, I love that you brought up inflation. A lot of people I've got, people that I know that are really successful in real estate. They're like, Bronson, why do you talk so much about inflation? Why do you talk about all this stuff? Why don't you just do real estate? And I say it's all related. Like, the game is changing perpetually. You print tons of money. You have a 400% more dollars in circulation than there were 20 years ago. So, and then of course it's exponential lately.
So there's 400%. That you're right, 400% than 20 years ago, but 40% more than 12 months ago.
Exactly, and it's getting worse. It's getting worse. Right. It's getting more and more and more, and so that affects kind of how you approach doing future deals and what you should do. So there's a lot of, and we'll have some more conversations around that as well. Thank you for setting the stage. That was really, really good. I know you mentioned this before, Neal, as well, but I know you and Jorge are both developers. Maybe Jorge, can you talk a little bit about how the development market has been affected, or some of the development deals that you're working on, kind of what changes you see in light of some of the post-COVID environment?
Yeah, I mean, you've got a lot of new developers out there for sure. I think a lot of people are realizing, like Neal said, when you're paying $120 a door for C-class and you can turn around and build it for $140, like, it really starts to make sense, right? So it's becoming harder, obviously, to find that land. Everybody says they're looking for 10-acre land now. It used to be a lot easier to find that. And eventually the pricing is going to start going up. I don't think it's quite there. Well, I take that back. I did see one yesterday that they're trying to sell for fully entitled. At least that's what they say. It's fully entitled. I haven't looked over everything, but 30 a door, which is pretty up there. I mean, we're used to paying maybe around 10 a door, 15 a door. So that trend is going to keep going up. And obviously you have all that demand too, right? So last year, the building costs going up, a lot of developers stopped building and then put their projects to the side. So now that it's come down some on the building products, a lot of people are going back to building. So definitely a lot of demand, which is going to then strike up the price again on product. As far as the opportunity, I mean, my bread and butter is still existing multifamily. I like to have maybe one or two new development projects going on at a time. But it's also more risk, right? Because it's going to take you a year and a half, depending how big your project is. I think we're in a good place right now for that timeline, but at some point you're going to take on a lot more risk of what's going to happen in that year and a half, 2 years, when it's time for you to lease up that product. Has the market changed?
So, you mentioned this too, and this is something a lot of people think about when it comes to development is you have some risk, right? You can't just immediately build a project. It typically takes time to entitle it, to plan, to buy the land, to construct it, those different things. So there are some risks involved that are different from doing a regular value add type of deal. Tyler, we're going to get back to you in a minute, but I want to hear from Neal on this topic. Just what do you see as being being successfully set up to have a good development, or what are some things that you look for in the developments that you do?
I think that starting with the right mindset. So first thing you should know is development is about 10 times harder than value add. There's just such an immense number of things. So if you're good at raising money, development's not for you. If you're good at project management and keeping 2,000 action items on a list in sequence, maybe you're better suited for development. There's just an absolutely incredible number of tasks that are tied to each other. Now, if you do one project, maybe you can be a little bit disorganized and get through it. So just so you know, I have 15 projects, $400 million in development right now, and they're in 8 different states. So the infrastructure that you need to build for project management is absolutely astonishing if you don't want delays. Having said that, none of that helped us when it came to the spiraling construction costs in the last month. Timber went from $400 a thousand board feet to $1,600, and then down to $600. So it was just crazy, right? So you don't know what you're thinking there. So we had to adapt. And what really helped us is that the markets that we had picked were so astonishing, like Mesa, Arizona. Rents have gone up 17% in the last year. So even though our construction cost for that project went up a staggering $13 million, the appraisal went up by $31 million. Right? So that's what saved us, because we had so many projects. So we had to go back and reappraise all of the different projects. So to me, I think, I don't necessarily agree with George when George says, you can buy something for 120 and build it for 140. I think that the new reality is that we're going to all be buying stuff for 120 or building it for 200. I just don't think that 140 number works anymore. And George implied that because his cost of land has just spiked from 10 to 30,000, a door. So obviously you're paying $20,000 more for land. Your construction cost is up between 12 and 25%. So our one of our projects, it went up 12%. One of it went up 25, and everything else was in the middle. Right. And so that experience is actually universal. Developers use that 12 to 25% number all the way across. And a lot of people were like, yeah, but the cost of wood is coming down, so this is going to be a one-off. I don't agree. I mean, I am not seeing that deflation happen once the cost of lumber came down, because now we have, this is headline news in the last week. So there's 75 ships parked outside Long Beach, California, which is one of the biggest ports on the West Coast. And these ships have been there for weeks. So there's a massive, Costco's running out of toilet paper again, right? So there's very, very significant supply chain issues, right? So General Motors is making 40% less cars because they can't find parts. Why is this happening? I go back to, when you create $10 trillion new dollars, that $10 trillion new dollars needs yield. Yield is created by making things, whether you're making cars or you're making homes. So I think that what you're going to see is construction costs will go up like crazy, and people will still build more because the market is so insane in terms of insatiable in terms of their demand, right? Austin's considered a flagship metro, but 100 miles away we have Austin, and we're in Northwest Austin, and projects are being offered 3 cap before they're built. So for somebody to say that we can continue to build for 140, I don't agree with that. I think construction costs are going to go up. They're going to be in the 200s. But so I think what's going to happen is that, as value add goes up like this, there's going to be brief time where maybe construction costs are a little bit close, and then the construction costs will go up again, and that gap will remain constant from before COVID to after COVID. So I do think that there's opportunity for developers. I'm really super excited to be a developer of 15 projects that are coming to market in the next 12 to 24 months. Some of them are already in market. And I'm really enjoying that ridiculous cap rate compression, but boy, it's been horrible for us to go and renegotiate every single loan with every single lender. And 2 of our projects, we had to raise extra equity. Some of them we had to go back and negotiate with our existing investors. So it was very difficult, but I think it was very worthwhile. So to go back to the original question is, today the skill set of being a developer is actually harder than it was 12 months ago. Bronson says, what do you need to be a developer? Firstly, you need to be super organized. And secondly, you need to understand that there's an incredible amount of risk here, because we're now having to build, George's example, $30,000 per door just for land. And we have to make assumptions of certain cap rates happening, 36 months from now when we're looking to sell this property. And if that doesn't happen, you have to adapt a lot. So adaptability is going to be key, and extreme organization is going to be key.
Thanks, Neal. Yeah, I think, whatever investment we look at, there's different elements that go into creating success. And I think one of the common things that go into that is on the metrics and the numbers that you use, trying to be very conservative. Now, we use this term a lot of those numbers thrown around. And I know, I don't know if you guys have seen this as well, where you see somebody say, oh, it's conservative. You look at the numbers, it's not actually that conservative. And so whether it's a development deal, it's a value add deal, it's something very important to look at. So Tyler, I was hoping you could kind of maybe roll back the curtain for some people that are looking to invest in deals, just saying, well, what really is a conservative deal? What does that look like?
Well, first of all, I agree with what Neal said earlier. It's going to be very challenging to be a winner in this market if you're overly conservative. So for me, it's like, you've got to be precise. If you want to win deals, if you're trying to make things happen, we've got to understand how inflation is impacting, every corner of the marketplace. And so if you're going to be overly conservative, you're going to be on the outside looking in on every best and final, of course, every awarded deal, no matter if it's on market, off market, or what have you. But I think, it's obviously important to look at, how are you structuring your deals? How are you financing your deals? What is your break-even occupancy? I mean, so obviously looking at, well, what are some ways that we can, one of the phrases in the crypto market is HODL, right? Hold on for dear life. We can never predict the future. If you're going to buy, a Bitcoin or what have you, and it's so volatile and it's going to 50,000, it's going to 20,000, it's going back and forth, hold on for dear life and see what happens. But, one of the things about real estate that I love is that, time heals all wounds. So if you have a challenge and you are, you're required to sell at that point, then you crystallize your loss. But in the future, let's just say you've got a break-even occupancy that's in the 60 to 70% range, how likely is that to occur? So I think that's one example of, looking at a deal and saying, well, how can we be conservative to say, look, one of the things that I'm very fond of is thinking in bets. If you've ever heard of Annie Duke, the professional poker player, she wrote a great book called Thinking in Bets. And so if you were to bet on, most multifamily across the United States in strong markets, how likely is your occupancy to go to 60 to 70%? It's probably pretty unlikely. And if that occurs, you're going to have probably a much larger issue. So that's one example of how you can structure your deals to say, well, wait a minute, what is our break-even occupancy? What type of loan to value do we need, to get to that perspective? And obviously, thinking about in terms of the operation, all right, well, what are our assumptions, right? Over the past 12 months, of course, we've seen record inflation, which has already been reflected in rent growth. Are we assuming that is going to happen over the next, 24 months, 36 months, and what have you? There's probably a strong likelihood that will occur. And I know I'm speaking in generalities here, but across the country in many very strong markets. And I know we'll talk about migration here shortly. And so, thinking about that, but also thinking, well, what if that doesn't happen? How does that impact the deal? And, one of the things that I think is one of the best qualities of multifamily real estate is people always need a place to live. So, the worst that can happen is you remain flat, or perhaps you don't hit your rent projections that you're looking at. And, can you still make this deal work? Can you still protect the downside? One of the things that one of our biggest philosophies is you never reduce or eliminate risk, you just mitigate it. And so those are just a few ways that we can do that, is by looking at break-even occupancy, understanding assumptions, thinking in bets in terms of where things could potentially go based on all of these different circumstances globally, throughout macroeconomics, throughout the United States, throughout the microeconomics of those markets that we're investing in. And so those are some of the things that we like to look at. But going back to what Neal said, man, it's going to be very, very tough to, make acquisitions happen if you're overly conservative. So I think there's certainly a balance there.
Yeah, I think it's interesting to look at what you said about really looking at the downside, right? How could I lose money in this investment? How could things go wrong? And it's really what you don't know what you don't know. And those are the biggest areas, especially as we probably have a lot of newer or less experienced investors on here thinking like, how do I get into deals and what does a good deal look like? And so it's becoming aware of changes before they happen or things that are on the horizon. So we've talked a little bit about inflation, which is going to have a significant effect, I believe, as well, like Neal and all of us. But what are some other things as far as some of the taxes in relation to syndication, cost segregation, phasing out, interest rates? What are some? I'm just going to put this out to the group here and just say, what are some things that each of you see as far as some changes that are on the horizon that will affect multifamily investing?
I think.
Go ahead, George. I'll go next.
Yeah, I'll be quick. Look, I think taxes and insurance are huge. They keep going up and up, and you need to know, like Tyler was saying, I mean, you really need to know your numbers right now. Nobody should be using rule of thumbs for anything when it comes to underwriting. And at least in Texas, taxes and insurance are getting out of control, and you need to be aware of that. And I'll leave it at that. As far as underwriting, just know your stuff. And location. We're going like micro location, like really knowing the location you're getting into, because like most of you are saying, these locations are, for the most part, when you're close to a Dallas or, a large major city, Austin, you're getting some massive rent growth, but you want to make sure it's sustainable, whatever that growth is, and that what's driving that and get down to the root of it, right? And make sure you understand it.
It's good. Thank you for that. Neal, do you want to continue there?
Yeah, I think interest rates will go up faster than we are currently projecting. So I think our big risk, I don't see cap rates being a risk. If you remember, you have to learn from the past. We were all worried about cap rates going up when interest rates went up. And in 2019 and in 2020, interest rates went up before COVID. And we still saw continuing cap rate compression because we think that all this, that all assets are getting repriced. So to me, I think I was a little bit too paranoid about cap rates going up when interest rates go up. Having said that, at this point, I think that the market is not pricing in interest rates increases quickly enough. I think that they have to go up much faster. I think this market still thinks, the Fed said 2 years, they'll take 2 years. No, the Fed said we are a data-driven organization that currently believes that we will be raising interest rates in 2%, and if anything changes, we'll let you know. Well, something just changed. Inflation is now at 6% and climbing. So I just cannot see that the Fed will not react. So if our vaccination rate keeps going up, and I expect there to be a spurt now because, mandates are coming. So there'll be a spurt there. And when that happens, investor confidence in our recovery from COVID will spike. When that happens, inflation will spike further and the Fed will be forced to take action. I think I see multiple interest rate hikes in 2022. And it's possible that we see one in December this year.
I think that's really a great conversation because there's a lot of people. This kind of brings us back to inflation, right? Because inflation, when it picks up, and again, the CPI, I did some work on this on YouTube, just talking about how the CPI really does not take into account a lot of things. It delays, says everything's transitory. They take, if you like apples and they go up 50%, they're like, well, you would eat oranges instead. You would switch to something else. So there's all this kind of moving things around. Even after doing all of that, it's still 6%, and it's probably actually substantially higher. Based on other things.
They don't include rent and real estate appropriately, right? So, look at rent increases, 17 to 39% in a year. So how can inflation be 6%? I don't understand it.
There's a website called shadowstats.com where it talks about.
I've looked at shadow stats. I'm not fond of their methodology either, but I do think that the truth is somewhere in between what the Fed says and what the shadow stats guy says. I think they take everything to the other extreme. So I tend to average it out, and in that case, it's 9 or 10%, right? But that's too high. I mean, the Fed cannot sustain an economy like this with rates that, with rates as low as they are and inflation as high as it is. So I think that we're just in this Goldilocks zone where they're waiting for there to be more people vaccinated. They want to feel comfortable that the recovery is taken hold, but then the Fed will be forced to do what it has to do.
So let's go down that hole a little bit then. So if the Fed at whatever point, 2-3 months from now, 2 years from now, whatever time frame that is, they raise interest rates, what does that do to the value of multifamily assets? Generally, you'd think asset prices go down, but in the sense of so much more money is now in the system that it may just be that it continues to rise.
I don't know if it's going to continue to rise, but I don't see it going down. As I said, if you all of a sudden create tens of trillions of dollars, it will search for yield regardless of the efficiency of that yield, right? Regardless. So in my mind, returns go down, right? We all four of us love to brag about the fact that real estate creates higher returns than stock markets. Well, what's happening is that returns are compressing for all kinds of assets. Stock market returns are compressing in the sense that, a stock is twice as much to buy as it was last year. So if you're getting in now, it's not very useful for you. So for those of us already in real estate, yay. For those of us not in real estate, well, your yield is dropping. So I think we are entering a new reality, a new norm, where yields are going to be lower. I don't expect cap rates to go up. I expect them to still see some compression, but I see that compression to slow down. But I do expect to see further compression in cap rates from where we are today, which is a sub 5 cap, for all multifamily in the U.S., 3 cap for for true Class A assets. I still expect to see compression there. There's a lot of people in the audience that are skeptical about this. And for those people, I encourage you to spend an hour researching cap rates in Canada, the UK, France, Singapore, Hong Kong especially. Look at the cap rates there. The U.S. is going to look like the cheapest place on earth.
Yeah, Neal, I appreciate your data. You're such a data-driven guy, so I appreciate all the value you bring with that. It's great. So we're going to shift gears a little bit and bounce around, talk a little bit more about basically how COVID has affected migration patterns for real estate. Let's see, maybe we can have George start, and then Tyler, you can jump on that. You guys want to, maybe George, you can start on that. How are you seeing that affecting?
Definitely enjoying it in Texas. It's driving definitely a lot of population to Texas and Florida, leaving your New York, your California, those type of states. I was hearing this a lot before where people were saying driving individuals to the suburbs, and I'm not 100% sold on that yet. I think it's, at least from what I see, it's just the population growth in general. Where are you going to move to? So at least here in Dallas and in Houston, you definitely see the suburbs growing quite a bit. A lot of opportunity there. Whether that's really COVID driven or just population growth driven, I'm not quite sure. But yeah, for the most part, you definitely see the population moving around and leaving a lot of states like California.
So I'm in Los Angeles, and going through COVID in Los Angeles has been a nightmare. I know, Neal, you're in California as well. And I've had to go to Texas, I think 6 or 7 times this year for different conferences, because you actually could do events that they would call super spreaders in California. They literally cut the power down in LA to the house because you'd have so many people gathered in one place. But so that's one reason why people like me would say, hey, I want to move to Texas or move to some other, Florida, or do deals in these areas for those reasons. But Tyler, what else do you see in this area? Why are people moving? What are some trends that you see continuing to happen?
Well, there's no question. I mean, mass migration is happening right now. I mean, you think about, Africa, and you think about the savannah and all the, the animals crossing the savannah, every July and August. I mean, that's what's happening in America right now. It's pretty amazing. And I think at the end of the day, there's a few factors. It's taxes, it's freedom. I mean, life quality and choice. And I think those are a lot of things that are happening. I mean, I had John Burns is a great real estate consultant. He wrote a book called Big Shifts Ahead. I think he wrote it 5 or 6 years ago. And I had him on the podcast, on Elevate podcast, and we talked about it. And this was in the middle of the depths of COVID. And I asked him, is there any revisions that you'd like to make on your book? Because he's talking about, the trends in terms of migration and consumption patterns. And he says, look, COVID is accelerating everything that we saw in mass quantities. And so, people were moving to tax advantaged states already. I mean, you look at the states with no income tax. I mean, they're the biggest winners in this entire thing. And so I think that's really, really interesting. I mean, we're talking about changes on the horizon. I think it's fascinating to me, just going back to the earlier topic, that, there is a lot of consideration that we should be looking at property tax hikes across the country. At the same time, there's no way that balances that budget. You think about 40% increase in money supply in the economy over the past 12 months. There's no way that any sort of tax hike on a property can really offset that. And so it almost seems like it's more of a political move than anything. But at the end of the day, I think consumers are moving to places where they can have more autonomy, they can make more money, they can keep more money, and they can have a better quality of life. So I think that's really interesting to think about. And every state that, has those type of policies in place are really benefiting. And you're seeing more compressed cap rates, more, offers on these deals more than any other. So that's what I'm seeing. But yeah, I think opportunity and freedom ultimately are the drivers.
Yeah, you mentioned this, that, basically people move obviously for freedom, for opportunities. I also think, a lot of retirees as well will want to move to warmer places that are a little cheaper. We've done a deal recently in Jacksonville where it's, mid-sized market, but for every retiree that moves to a southern area, you'll have 4 or 5 different people that need to go support that person, right? You need healthcare workers, you need people to clean the house, you need retail people, you need all the restaurants, all kinds of different people to support. So there's so many different things. And I know, Neal, I've really appreciated your work on just the data that you use to try to understand migration patterns. Can you talk a little bit about your strategy, about how you understand what the best markets are to invest in?
Sure. I think that migration will accelerate, but not quite the way it was pre-COVID. I think that there's a difference here. So, COVID is the single greatest event in modern history. It beats World War II. There were hundreds of millions of people that actually had no changes to their life in World War II. And the big reason why COVID is different from World War II is we've just trained 350 million CEOs on how to run their companies differently. Every single CEO in the world now thinks differently from 12 months ago. And no other event that I can imagine would conceivably have had created something this big. So the impact of COVID in terms of migration patterns is ahead of us, because now you have a whole generation of new CEOs coming to the marketplace that actually think differently about how to hire and where to hire, right? So we've still got, legacy CEOs that were affected and are much more open-minded. So to us, COVID brainwashed 7 billion people. That is not something that you can reset by simply ending the pandemic. People think differently now. And so migration patterns will accelerate. They've already accelerated. We see, outbound migration from some of the big metros. New York especially took a massive hit. But I think that it's actually going to spread. So what was happening before was people were just going to Phoenix. Now they're going to Buckeye, Arizona, which is 45 miles from Phoenix, right? They're going to Maricopa, which is another 45 miles from Phoenix. They're going to Tucson, that's 90 miles. So Phoenix now, its inbound migration is actually spreading in a 100-mile radius, because now you can do that. People are willing to do that. They're willing to ask their employer for flex jobs where they were afraid of it before. So we're estimating that of the working population of the US, roughly 22 million people post-COVID will work in a completely different way. 22 million is such a gigantic number that if those people they migrate and their migratory patterns are different, it changes things. So my biggest belief is this, that the data shows me this: the time of the true tertiary market has come. So when I say true tertiaries, I do not mean San Antonio, Jacksonville, I don't mean Phoenix, Las Vegas, Orlando, Austin. These are not true tertiaries. I mean, 67 miles from Austin is Killeen. I think Killeen's time has come. 48 miles from Austin is New Braunfels. I think its time has come. 130 miles from Salt Lake City is Idaho Falls. I think its time has come. I think true tertiaries, which do not have a major metro near them, are going to see an extraordinary growth. Missoula is going to see extraordinary growth. You're going to see growth in like all these Montana markets that are seeing just absolutely astonishing numbers in the last 12 months. So we're tracking these markets and we're going, so people are really beginning to put a very serious amount of money into true tertiary markets as being not their secondary home, but being their primary home. So we're seeing an early wave of risk takers. They're like, I'm going no matter what. I'm going to go and live in Missoula because it's fantastically beautiful. I'm going to go live in Coeur d'Alene. This is the early, risk taker crowd, right? They don't truly know how COVID's going to, pan out. But now within a year or two, when hybrid work and flex work becomes the norm, the people like me that are not taking risks, they're going to start heading out, and you're going to see some absolutely mind-blowing numbers in beautiful places throughout the U.S. So my message is simple. Migration patterns, sure, Phoenix will benefit, Austin will benefit, all these places that we talk about will benefit. But I think the biggest beneficiaries are true tertiaries that are beautiful. So if you have a place that you live in like Destin, Florida, that's gorgeous, right? You're going to see crazy, crazy growth there. You're going to see crazy growth in Asheville because it's a very, very nice looking city. So, we've seen a lot of growth in Raleigh. We've seen a lot of growth in Charlotte. But now people are like, Asheville's prettier looking than Charlotte. I don't want to fight Charlotte traffic anymore. I'm going to go to Asheville. Now you can. You have the ability to do that. You have the confidence to do that. So we're going to see true tertiaries in the U.S., their cap rates are going to completely go nuts in the next 5 years.
I think that's a great point, Neal. That basically before we couldn't do it. Everybody had to kind of, most people worked in an office. Now most people work remotely, and we've seen people, especially in LA, everybody, a lot of people move to other states and just like you said, beautiful places. So that's another driver where you can have a much better quality of life. George.
And Bronson, don't forget that institutional capital for the first time in history is now looking at tertiary market investment. Right? So who said, the world is run by people who have trillions, not people who have, millions. The trillion guys are like, this changed the world forever. I understand it because they've got 70 analysts researching the same stuff that I'm researching. And they're like, the age of the tertiary has come. For the first time, we will invest in a true tertiary that doesn't have an anchor market near it.
Yeah, absolutely.
So we've,
go ahead, George.
Firsthand witnessed that. We did some research and we liked what we saw in South Dakota, in Sioux Falls and Rapid City. Bought 2 properties there end of last year, beginning of this year. They're performing ridiculous. 99% occupied. People are just massive waiting lists. We're pretty much charging whatever we want for rent. And same thing with Augusta, Georgia was another market that we liked. We went in there in February. We've literally, as of last week's report, we're almost at doubling the income in, end of February, so 6 months, if even. Yeah,
I agree. Rapid City is incredible at this point of time. I think that you could not make a mistake in Rapid City. So there's so many of these places around the U.S., and I think people will learn these names because the truth is, 10 years ago when I got into multifamily and what's his name, the one of the big gurus was basically talking about, Jacksonville and Atlanta. Well, 10 years have passed, and the average property in Atlanta that was $45,000 a door is now $130 a door, right? So things have changed there. So we need a new set of cities, and this is an incredible opportunity to get that.
You to find that yield like you were talking about.
So that's actually a really good point, Neal. I know we traditionally kind of the thought is, at least if you look at institutional, it's historically been that bigger markets are safer, but it's almost like you're saying it's like the opposite now. So buying in smaller markets and beautiful places, particularly, it's safer just because these are more desirable to live. Is that kind of, I guess, investors that maybe are used to saying, I'd rather be in primary, secondary markets. How do people, make that shift over? Is it just kind of like, hey, here's where people are moving and it makes sense and go for it? Because I know a lot of people, they prefer, or a lot of institutions prefer larger markets.
Well, safety, I think, is a different concern. So I would say today, Los Angeles and San Francisco Bay Area and New York are less safe than Phoenix, Austin, and Nashville. But I would not go venture so far as to say that, a true tertiary is now safer than these secondary cities. I think the sweet spot is still the secondary from a safety perspective. And you'll see cap rates compress there as well. But I think from a yield perspective, the game has moved away because the secondaries, their yield is now down to almost zero. I mean, cash flow is not there if you're buying in 2021. Yes, we bought properties 12 months ago that benefited from these big, crazy rent increases. But, the people that are listening right now, they want to know about the next 12 months. And in the next 12 months, where's the yield in the secondary markets? I mean, Phoenix is basically getting the same cap rates as the San Francisco Bay Area. And I think it deserves to, because a lot of people are moving there. Same thing for Texan markets that George is in, right? I mean, I think those markets deserve it. But then as the cap rates go down, the cash flow goes down. So I think the yield story is going to move to the true tertiaries, but I think the safety is still in the secondary.
So we're getting
I
a
think
few
the primaries
questions.
are not safe anymore.
Right. No, I agree. I think primaries are definitely risk there. So we're gonna shift just to go through some questions. There's one that kind of touches on what you mentioned, and we're gonna kind of toss this around. If you do have a question and you're interested, please don't be shy. Drop it in the box. We'll get to as many as we can over the next few minutes, and then you can also reach out to myself or anybody on this panel. We'll leave our contact information or ways to be able to connect, or maybe post a question through other sources. So Joseph asks in the chat box, with the 10-year compressed at 1.3, so 10-year treasury fixed at 1.3, what kind of cap rate expansion are you factoring for your current deals with a 3 to 5 year exit?
This is the age-old question, right?
Yeah.
Age-old question. What should our exit cap rate be? I mean, every deal is obviously unique. I mean, like Neal, you were saying this earlier, or I think it was George, actually, you were saying, if you're just using rule of thumb, I mean, you're going to get blasted in this market. So, the rule of thumb is, hey, 15 basis points on an annual basis, is a way to look at it, or 15 to 20 points. But it's all so unique. I mean, we've got a deal right now that we're looking at, remaining flat on a cap rate on an exit. But how can you say? I mean, you're putting a finger in the wind, but I would definitely be curious to hear what you guys, what Neal, you're shaking your head. I'd love to hear your thoughts.
Flat. I'm not. Yeah. I am not underwriting with a increase on the other side, simply because in my mind there are two things pulling. The interest rates are going to want to move cap rates up, and the $20+ trillion that the world just printed are going to want to make them go down. So my bet is straightforward. That $20 trillion is going to beat the interest rates. And if you look carefully in 2019 and 2020, that's what happened. Interest rates went up, cap rates went down. I think we accelerate that process. So I am underwriting flat.
I've been doing 15, just lowered it to 10. In my mind, flat is what I'm thinking all day. I just, I know it's the question always comes up. Honestly, we may start doing it flat.
So for those that aren't familiar with this is talking about whatever your cap rate, if you're purchasing at a 4.5% cap rate, it's traditionally been said you should raise the cap rate at exit when you're selling, but there is conversation to say maybe you should keep it flat, and that's kind of what we're talking about. So that basically it's what sort of returns are you expecting to get when you sell? So there's a question that comes from Lee that talks about some specific changes to underwriting. I think a couple of you guys have mentioned that you can't do rule of thumb. What other specific changes? We talked about exit cap rates. What are some of the other specific changes that you're making, or maybe a couple examples of we underwrote it this way because it's different in this market now, or because of this, we have to pay more for the land. We're assuming higher growth or higher costs, or what are some other changes in underwriting you're seeing?
Employee costs. I mean, we're assuming higher labor costs. We've gone from $6,000 for the standard rehab to $6,500 to $7,000 to $7,500 to now underwriting at $8,000. Simply because we can't buy cabinets at the same price. I mean, we just can't buy countertops at the same price. Everything goes up at 5%, 6%, 10% every quarter. So, I mean, if you're underwriting using the previous rule of thumb for your rehab, you're never going to finish your rehab.
I think that goes with payroll too.
Payroll, yeah, payroll's going a little crazy. It's everything is not rosy here. Right now, underwriting is really hard because if you take on the inflation expectations, then you've got to underwrite your payroll and your rehab completely differently. That's why I'm saying you have to assume higher rent growth than we've been used to assuming. I used to do 2%, then we did 2.5%. Now, and we're only investing in certain weird markets that nobody else knows, where rents are going up 13% a year. So we're doing 3% now. It's just impossible to underwrite at 2.5% and get a deal.
Right. No, it's very true. The underwriting, I think one thing that people, that I've noticed to talk to my property manager friends or people that are in property management, they're saying it's really difficult to even find staff that will come to work because of, especially in places like California, where the extra unemployment is actually encouraging people not to work. And I know a number of cases that's true. So if you need to get an Uber in LA, or I don't know how it is in other markets, it can be way more expensive or just very difficult. So this is creating labor shortages all around. So there's all kinds of issues happening, and obviously it's something that it's very dynamic. So let's see. I know we have more questions here. So somebody's asking specifically about bringing deals. Maybe you can just kind of each share on a personal level. I know some of you guys do stuff. I think, are all of you vertically integrated, or you find your own deals, or do some of you work with deal finders, or how do you guys find your deals? Maybe that's a better question.
I do both. Internally, we're always looking for deals, a lot on relationships, like Tyler said. We try to get truly off-market deals, or at least pocket listings. And then we have a lot of investors that bring us deals to help them close on. So a good mixture of both.
Yeah. We only do a finder's fee. We don't do joint GPs. So we've got 3 people in our own team, but we're happy to look at anything that anyone finds. But just a finder's fee.
Yeah.
Yeah, to date we've just been sourcing our own deals, but we're open-minded. I mean, I think there's going to be a lot of opportunities over the next 5 to 10 years, especially. So there's a lot. The beautiful thing about this business is the abundance mindset in reality. So I love the questions, and we're always open-minded to do good deals with good people.
Yeah, it's amazing too with syndication, the value of partnership. It's like a puzzle. If somebody, like, we do more, bring capital to great deals. We invest and bring friends and family involved in different deals. In other groups, it's they do a lot. They do all of it, or they'll do more of the operations side, and we'll partner together. So it's just an amazing team sport that it's very difficult actually to do by yourself. I mean, anybody who's doing a syndication by them is very, very difficult. That's why team and partners become very important. So if anybody has any more questions, we're kind of slowing down a little bit on the questions. I'm just going to put 1 or 2 more in here, and then we'll go ahead and wrap if we don't get any more questions. So if you're sitting there with a question, don't be shy. Lori's asking, what do you see in the Midwest? Like, what kind of opportunities or markets as a whole? I don't know if anybody, I know, Tyler, you work a little bit in the Midwest. Any thoughts of what's, opportunities you're seeing there?
Yeah, it's off the radar of many people, so that obviously creates opportunity. We just bought a 247 unit deal in Indiana recently, and it's a phenomenal deal. And I mean, I'm not even going to tell you the price per unit that we acquired this asset at, because people are going to scream. But it's certainly it's a C-class asset that has its own set of challenges, and as I mentioned earlier, we got to solve problems, but it's a market that is basically flat, a little bit of population growth, a little bit of job growth. It's not a highly dynamic market. It is a tertiary market, but we see opportunity there. And one of the things that I think is really interesting, you were talking about, all the different dynamics that are occurring. We didn't mention, eviction moratorium, how that is still in place. And a lot of workforce housing, you've got a lot of folks who are still in a precarious position in terms of their own employment. And one of the reasons why we like that particular asset in that particular market is because it's a contingency of individuals who will be supported by the government in the event of, major, personal financial disaster. And so obviously we're not counting on that to happen, but it's another example of thinking in bets in terms of, all right, well, if certain circumstances continue to play out, how do we, mitigate that risk? And I know that doesn't particularly pertain to Midwest or any different region, but that's one of the things that we think about as well. But we see a lot of opportunities. I think it's a contrarian viewpoint. It's, let's look left while everyone else looks right. And we like to find great opportunities in markets that are not on the front page.
You touched on this about the eviction moratorium, and I think it's important we kind of touch base on that. So, other guys, what do you guys think about what's happening currently? Do you see this being extended perpetually? Like, how does this end? What's the fallout from it? How are you dealing with it?
I don't think it has any impact on our business at this point at all, unless you're in California or one of these, states where it's a big deal. So Southeast and some states in the Midwest, at some parts in the Midwest, there's a significant impact. Like Chicago is very renter friendly, so there's still a massive impact there. But if you're in a fairly landlord friendly state, I think the impact is fairly minimal at this point in time. I mean, rents. Last month was the best month of rent collection since the pandemic started, and the numbers are within 1% of collections as they were before the pandemic. And I absolutely do not expect that to change. And by the way, Tyler, I did want to say, contrarian, but more people coming to that conclusion. So I do not invest in the Midwest. I still think that the Midwest today is better than the sexy Southeast. I think that Midwest will enjoy an incredible all ships rising effect, simply because the per door prices have gone completely haywire in the Southeast. Having said that, I still will not invest there. So I have a mindset where I don't want to take that risk, but I think that today our data shows that the Midwest is better than the Southeast in terms of going forward profit.
George, you have any thoughts on the eviction moratorium?
Same thing Neal said. I mean, we're not feeling it right now.
Yeah, exactly. It's been very, very manageable in the markets that we're in as well. The question is, it seems many promising states mentioned don't have rent control laws. Is this a coincidence, or is it causing a significant risk you're avoiding? So I guess the question is about rent control. Obviously we avoid, I think all of us in general avoid places with rent control, but do you see maybe rent control becoming a risk in some of these areas that you invest in?
I would say, places like Austin, where you have a lot of the same mentality moving from California to Austin, maybe, but other than that, I don't think so.
The only city I thought of was Austin. So Austin is at this point more representative of California's mindset than it is of Texas, especially core Austin, maybe not the outlying suburbs. So I think that's a risk. They could go that way. But I don't know of any other place that doesn't have rent control right now that's looking to implement it. I keep an eye on these things. I'm not seeing anything. I do want to say that all rent control states are not equal. New York is draconian. Oregon's very decent. I would not, hesitate to invest in Oregon simply because they have rent control. I think it's a very fair type of rent control. I'm not investing in Oregon at this point for other reasons, but I don't think rent control is a reason not to invest.
Right. We actually have Abner. He's here. He's saying that he lives in California, and he was talking about the eviction moratorium, where you could say rent control or whatever factor you want is the main factor pausing my willingness to become an investor. And we say, well, Abner, you got to look outside of California because your deals are much better.
What are you doing? Listen, this is a quote for you, Abner. I'm a liberal Democrat that only invests in deep red states. Right? Yeah. So political philosophy is not the basis of investing.
That's great. And the other thing too is a lot of people think you have to do it yourself. To be an investor, you've got to buy a duplex, you've got to buy a house. All of us take passive investors. We do deals all over the country. Found a really great way of doing it. So reach out to any of these guys. They can show you basically how that process works and make you feel comfortable with that. We'll take this we'll do this question, and then we're going to kind of wrap here. We'll just kind of take some final thoughts. But Leah's asking, are you finding that you have to assume an interest-only loan and avoiding taxes for the first 1 to 3 years in order to make deals pencil these days? I'm not sure about the tax return stuff, but are you finding that interest-only loans and just really getting creative with loans is the way that you're making your deals work now?
Interest only and bridge. And
Yep.
bridge.
Structured financing for sure. And even
We're
using
doing a
some
lot of debt
rates for-
funds.
Yeah.
A lot of debt funds, interest only for 3 to 5 years, and on our end.
So with a bridge, I guess a question comes up too, is if somebody gets a 2 to 3 year bridge or a 2 year with a year extension, in 3 years, obviously you have to sell or refinance. What is the risk that each of you sees in being like for having to do something, either having to go get a loan, all of a sudden rates are much higher, or having to sell the asset at that point?
It's based on belief, right? My belief is cap rates will remain the same. The new buyer that comes in will simply make less money than we are. That if you don't believe in that, you shouldn't be investing in multifamily, because we know rates are going to go up, right, as the economy recovers. So if you think that cap rates are going to then go up when rates go up, don't invest. I think that there's nobody in this room that believes that. I think cap rates stay. So when I can exit at a 4 cap in the future at my cap rate, the only scenario in which I could be right is if the buyer is willing to take a lower cash flow than I'm getting today. And I think that is what is going to happen. In a world where we just suddenly create $20 trillion there, and with only the same amount of stuff to buy, crazy stuff happens. How do you explain the fact that Bitcoin went from 7 to 49,000? People have to buy stuff, right? So to me, I think that the next guy that buys our stuff is going to take a lower cash flow or a higher risk. I think we have to make that assumption because we are seeing it come true in every aspect of investing, not just real estate.
And I'll just stack on that, because thinking in bets, I would bet that in 3 years from now, rents are going to be significantly higher as well. And I think that rents and the income is going to outpace expense inflation to a degree where, even if the yield is more compressed to the next buyer or, to the lender, the servicer, that everything makes sense from that perspective. But it's none of us have a crystal ball, but we have to think in probabilities.
Yeah. And I think, we set ourselves up for success. So most of the bridge loans we're getting into, they're 4-year terms with extensions. The second we close on a deal, we're executing that business plan as soon as possible. So we're buying ourselves time to figure out what we're going to do.
And we're buying rate caps. They're cheap right now.
Yep.
So we buy rate caps. So, people are like, what if, you have floating rates? So what? I have a rate cap, right? So if I underwrite for that, I'm not going to go upside down.
Yep.
Correct. Same here.
Right. Well, gentlemen, this has been an awesome conversation around multifamily. And there's some things that, they are shocking things that we're learning, but it's also one of the amazing things about multifamily is it is such a bread and butter type of amazing investment that every investor, if they haven't invested, should invest passively in one deal. I've had over 1,200 individual calls with investors, and there's, commonly there'll be a doctor that, has $5 million in net worth and has never invested in a deal. And just the idea of investing a small amount, 50 or 100,000 in one deal, you understand you can get better returns. You can get amazing tax benefits, and just the awesome power of being a passive investor is incredible. So I encourage each of you to reach out to each of these operators. They're stellar guys. And I really want to honor each of you for coming on and for your role in this space that I think is really, it's really powerful for a lot of people because it takes money out of Wall Street and into Main Street. So thank you to each of you for what you are doing and also the value that you added today. So I wanted to mention in the chat box a couple things here. Our next event is going to be about inflation. Actually, it's going to be called the End Game, and I've got a guy named Jason Hartman and Brian London, who leads the New Orleans Investment Conference, is going to be there. And then I've got a third person who's has not confirmed yet, but they are phenomenal. I'm really excited to be able to announce that. That's going to be on September 22nd at 4 p.m. And then also, I just launched my podcast today. So it literally has just gone live today with 3 episodes. I want to have each of you on there. So I'm going to put out an invite to each of you guys to come on. Would love to have each of you share. We'll have more in-depth conversations around multifamily, around inflation, around different topics that have to do with passive investing. So again, thank you everybody for joining. This replay will be sent out to you shortly. Feel free to share it. And again, the best investment really you can make is in your own education. So just want to again say thank you, each of you, for joining us today. So any final comments from anybody here?
Thank you for having me,
But
Bronson.
I'm shaving my head off for the next one.
All right. Hey, that will really be truly the shocking news. We'll just put a picture of you with a shaved head. So, all right, gentlemen, thank you so much. Thank you to all who are attending, and we'll look forward to seeing you at the next event. Thanks, everyone.